Michael Cochran here with BentOak Capital to provide our May 2023 market update. Please remember to stay tuned at the end of this video for a required disclosure statement. Spring is often thought of as an uplifting time marked by growth and renewed hope as we emerge from the long months of winter and look ahead to the rest of the year. Investors saw signs of such renewed hope in recent weeks, especially on the inflation front, as several inflation measures showed signs of improvement. We also saw markets stabilize after the surprisingly fast collapse of Silicon Valley Bank. But although it initially appeared that a stable spring would set the markets up for a calm, quiet summer, a flurry of recent activity is testing investor sentiment. Another bank collapse also put investors a bit on edge as JP Morgan, with financial support from the FDIC, will acquire First Republic Bank, the second biggest bank to fail in U.S. history. The story was similar to Silicon Valley Bank, with a concentrated and wealthy deposit base and mismanaged bond portfolio. These unique characteristics and a government backstop make any other large bank failures unlikely in the near term, though sentiment around bank conditions is fragile. In other significant news, Treasury Secretary Janet Yellen warned that the date when the U.S. might not be able to pay its bills is fast approaching if the debt ceiling is not raised or suspended soon. With the time for debate shrinking, the Treasury encouraged Congress not to wait until the last minute to resolve the debt ceiling issue, as they did in 2011. This urgent warning may actually provide a silver lining for investors, however, if Congress is pushed to resolve the issue sooner and avoids a summer-long congressional debate. Markets may stabilize once the debt ceiling issue is resolved and the Fed ends its current interest rate tightening campaign. As it relates to the market, recent earnings have provided a welcome and counterbalance to the previously mentioned topics. Analysts had forecast a 6 to 7% year-over-year earnings decline in the first quarter, slightly worse than the roughly 5% decline in the fourth quarter of 2022. What we've gotten has been much better than that due to several key factors, including economic growth that hung in there, companies operating more efficiently with changes over the past year, revenue surprises to the upside, and the U.S. dollar pulling back slightly, benefiting international earnings for multinational companies. These positive surprises contributed to an increase in the consensus 2023 earnings estimate during earnings season, offering a sign of stability. While every cycle is different, looking at past inflation peaks can provide some insights on both recessions and the outlook for stocks. If the economy were to go into a recession in the second half of the year, we could chalk up the more delayed economic downturn to a Federal Reserve that was initially behind the curve in fighting inflation, along with monetary policy acting its typical lag. When it comes to market behavior, it shouldn't be surprising that the S&P 500 index returns fared better in the year following peak inflation than in the year prior. Historically, returns are negative in the year leading up to that peak. That makes sense. Markets are adjusting to the real-time price experience of higher inflation and its potential policy impact. By contrast, average returns are positive the year after peak CPI, but just roughly in line with the average overall. Looking ahead, we see several signs of health for the economy and markets, such as delinquency rates on consumer loans still below pre-COVID-19 levels. Although business hiring intentions have slowed and consumers are pulling back on spending, we do not see the types of cracks we observed in the years leading up to the great financial crisis. We may not have a clear path for growth just yet, with some banks still under duress and the debt ceiling yet unresolved, but we believe the upward trajectory remains thanks to a relatively healthy consumer base. That wraps up this month's video, but please visit the Resources tab on our website for several new blogs and resources. If you have any questions, please feel free to contact us, and if you know someone that would benefit from our services, please pass along our information. We continue our commitment to providing personalized service to you and your family in any economic and market environment.